Just like many Americans, you might be focusing on saving money while eliminating your debt, but eliminating debt does not happen overnight. It might take years, even decades to accumulate it, but working out of debt, even on a lower income with the debt reduction plan, and that's exactly what we're going to be looking at today. It is going to increase your success and really looking at a timeline of when the debt can be eliminated in its entirety. If you start at 12 months, you can kind of work out from there, but I want to break down some of the steps that I do use when it comes to debt relief and really the debt associated with coming up with steps to strategize it. Now, the first one, looking at your budget and squeezing more money out of it. This is going to be a permanent, or really for some people could be a temporary solution. Looking at your monthly spending, seeing exactly where you can cut. This could be including making a budget, making a spending plan, using a budget tracking app, but making sure you know exactly where every dollar goes. That is one of the huge things. A lot of people overlook it. A lot of people, especially younger generation, don't want to work in a budget. They don't want the constraints. They don't want everything that comes. But when it comes to getting out of debt and being debt-free, looking for any opportunity that you can to cut spending, dedicating more money to eliminating that debt and getting rid of it as soon as possible. When you even start looking at small cuts, for example, if you find $200 that you're spending that you can cut out of a multiple of different ways, adding that into a budget, you're putting $2,400 every single year onto that debt, eliminating it much faster. Second one, automatically pay your debts. This is super important for really two reasons. Number one, you know that payment is made. Number two, you know that your credit score is not going to be affected by missing these payments. If you want to be free from debt, you have to make sure you put these on autopilot, guys. Even if it is just the minimum payment, looking at your credit cards, looking at, your student loans, looking at all of your bills, you have to keep track of the due dates, especially if you're paying off a bunch at once, which we're going to break down a little bit more in the video. Now, using debt management app, again, this is one that you can track progress, but you do have to check in with it on a regular basis. If you are using some of those debt tools that are really systematically trying to eliminate debt, does take a considerable amount of time, depending on how much you're throwing at it, which is adopting your payoff strategy. Now, we've talked about these two before. We have the debt snowball and we have the debt avalanche. Dave Ramsey goes debt snowball, which of course is listing all of your debts from the smallest to the largest, tackling that smallest debt first while making minimum payments on everything else. And as you eliminate that first debt that you do have, that smallest debt you have, it is going to give you a sense of momentum and really snowballing it into another debt. So what we mean by this is, let's say that first debt is $500 you have, and you're making minimum payments on everything else. And out of that, because you are making minimum payments, you have an extra couple $100 to put on there. As soon as you're eliminating and that first debt is gone, it snowballs to the next one and down to the next one and so on and so forth until all of your debt is eliminated. Now, the other methodology behind this is the debt avalanche method. This is the one that I use because I know numbers, and really when it comes to mathematics, when it comes to stats, it seems to work a lot better because you get more bang for every dollar that you're putting in there. So in this method with the debt avalanche, you are going from your highest interest rate, not worried about the dollar amounts, but you're looking at that highest interest rate and you are working down into your lowest interest rate. This means that every single dollar that you're putting towards that very high interest rate is going to help you pay less interest over time, even if you're tackling the high debt first. But the big thing with this one is the psychological aspect. If that highest interest rate that you do have is also the highest balance you do have, it might take a little bit of time to get that paid down or start moving the needle on that one, depending on how much you're putting in it. And that's where people can get a little bit more frustrated because they're not seeing the results as fast as they wanted to, that you could see in the debt snowball method. But it also makes a big difference as long as you're using one of these two methods and you're using it on a consistent basis. Guess what? You are going to join me in the debt-free journey right back here, and it will be completely paid off in a matter of time. Now, when we start talking about some of the creative ways that you can use finances to actually eliminate debt, first one is the balance transfer credit cards. Now, if you have, again, thinking of the debt avalanche, if you have credit cards that are 20, 25, 30, 35% interest, you could balance transfer, and some of the balance transfer cards do not charge you anything for the balance transfer. Or if you transfer to another card, you could have 12, 18, 24 months. That is 0% or 0 APR on those balance transfers. And of course, you have to make sure that when you're tackling this, you're not just moving debt and then accumulating new debt. This is the biggest probably myth or the fallacy that I see. A lot of people will move money to balance transfer cards that have that 0% with the best intention to unfortunately pay it off. When it gets to that point and it is on that balance transfer card, they never get to the point of paying it off. It starts accumulating credit again, and they find out the cards that they just balance transferred or consolidated now also have a balance. So they're kind of double dipping. Now you have more bills essentially than you did before, but it does allow you, if you are very, very focused on it and very dedicated to it, you can pay off your debt much faster at a much lower rate. And of course, you can pay it off and put extra money towards that, eliminating it as fast as possible. The other consideration for this is a debt consolidation loan. Now, again, when you think of the 20 to 35% interest rate on credit cards, debt consolidation loans run about 8 to 10% if you have good credit. Even if your credit is not quite perfect, you might be looking at a 12 to 15%, which again, when you think mathematically, if you have a card at a $10,000 balance, if your 25% interest rate is going to 12%, you're going to be saving and more money is going to be going towards the payment every single month. But also the big thing that I see with this and the problem with it is a lot of people will see the much lower payment of the debt consolidation loan. All of a sudden, they are only making that basic lower payment. So if the monthly payment on your credit card is $250, people are taking out debt consolidation loans for 7 years. Their payment is $145, and guess what? They only pay that $145. They're not snowballing and they're not moving that additional debt and eliminating that debt as soon as possible. They're sitting on it, and they're sitting on it for an extended amount of time. Now, of course, you could also look to credit unions. Credit unions do have fixed rate cards, which are considerably cheaper when you're looking at consolidation loans or those balance transfer cards, and they have no balance transfer fees. So definitely look out for that. Now, another thing that we're seeing, and it's really big right now, is either doing a paying off debt with a cash out mortgage refinance, which, like a lot of people, you don't want to get rid of that really low interest rate that you got a couple years ago. So instead of doing the cash out mortgage refinances, we are seeing the home equities or the fixed rate home equities that are taking money out there. So what they're doing is the debt has gotten to a point where they can no longer afford the monthly liabilities. It is getting out of hand. They need money and they need to refinance it. So Americans are taking all of this debt and they're rolling it right into all of the equity that is now built into their house, because the value of houses are at an all-time high, meaning the equity is kind of built in there. But essentially, the way that I look at this is if you're using your mortgage, whether it be a cash out mortgage or maybe it's a home equity, you are turning your mortgage into a really big liability. And of course, with all of that debt you're consolidating into it, it is another opportunity that financial institutions could foreclose on your home if you're not making the payment. God forbid if anything happens, I don't want you to lose your house because you had credit card debt, which is kind of crazy. Now, when we start thinking about the elimination of it, making extra money, this could be picking up extra hours at work. It could always be extra money with the side hustle, just like what we do here on YouTube. And if you like the content, definitely subscribe to it. But you could be looking at part-time job. You could be looking at extra hours. You could be looking at any way and any options that you can think of to generate additional income. And again, this could be something that is kind of short term. If you're making an extra $50, $100, $150 a month, that can go straight into debt, guys. That is going to eliminate it, lowering that monthly payment, lowering the interest that you're paying. And of course, eliminating that debt, being debt-free is the ultimate goal. Now, if it gets to a point that you need credit counseling, I am a certified credit counselor. It is something that I absolutely love to do. We do financial counseling and really coming up with budgets. I do a lot of it. If you need help, guys, definitely let me know in the comments. But a lot of nonprofits do it for free. You have to be very careful. There are a lot of debt management companies, a lot of debt management plans that charge you money, that try to help you or say they'll help you when it comes to finances, when it comes to interest, when it comes to fees. It's kind of crazy that I've helped a lot of people through my years without any charge, without a price tag, without charging them more money, just helping them systematically and holding them accountable to those debts. Now, when it comes to credit counseling, kind of goes hand in hand. If you do have collections, if you do have things like that, you can renegotiate some of your debts. Now, this is what a debt settlement company does. But guess what? You can do it yourself. You can call them, you can really negotiate your debt, accepting a smaller amount, because essentially either one, you're going to stop paying, the company is not going to get anything, or two, you can negotiate to make monthly payments, or paying it off for a smaller amount, and they're going to get their settlement and they are going to be completely done. Now, again, you have to be careful with some of these companies that provide a service at a cost. So not only do you have the debt, but you're kind of digging yourself into a deeper hole with these debt companies. And some of them do work pretty well. And I know there's a few reputable ones out there, but overall, it's mostly what you can do for yourself. Now, in the final one, and this is kind of where the straw breaks the camel's back, discharge or debt or declaring bankruptcy. This is one when it becomes overwhelming. There's no reasonable path forward. Declaring bankruptcy might be your only option. This wipes out your debt, creating a fresh start so you can rebuild your finances, but it also tanks your credit for 7 to 10 years. It will severely damage your credit score. For instance, when I did work at a financial institution, if you had bankruptcy, they would not lend to you for the first 2 years after bankruptcy. So you were blacklisted from everything, whether it was a Chapter 7 or a Chapter 13, you were blacklisted from everything. Now, when it comes to the court-appointed repayment plans for some of the debt, that could also happen. People think going to bankruptcy, they're just going to wipe the slate 100% clear. If you do have a decent income and just can't manage your finances, I know people who have, one, been denied for bankruptcy. They went, the bankruptcy judge or the court said, hey, you make too much money, you're just not managing it correctly. We're denying the bankruptcy. We will not let you do the bankruptcy. And the other side of it is, hey, we're going to make you do these repayment plans versus bankruptcy. So we're not wiping everything clean. We're making the payments or making you pay the payment plan that is agreed to. The bottom line here, guys, you can plan to eliminate debt, and a debt elimination plan is exactly what I did years ago. I have my mortgage, which again, by the age of 50, it is going to be paid off in full. That is my timeline within the next 5 years. Cutting my monthly expenses was the game changer. When I started eliminating my bills, first we got rid of the credit card debt, we got rid of the student loans, we eliminated the card payments, we eliminated all of our credit card debt, all the variable expenses, and guess what? We are right down to just having a mortgage, and that is it. So regardless of where the interest rates are, doesn't really make a big difference because we're not borrowing anything. We have not borrowed anything in about 8 years now. So when it becomes too stressful, when you feel like you're stuck in your situation, there is a lot of things out there, including some of the financial educators and counselors on YouTube. So again, if you like the content that I'm putting out, definitely subscribe to the channel. Let me know in the comments what you guys think, and I'll catch you in the next video.